This right here, this candle right here is a mitigation block. Now, I don't talk too much about it, but it is basically the opposite of a breaker, but they are still both mitigation in essence. Now, we have a high, a low, and a higher high. No, lower high. You see that? That low between it is a mitigation block. If this high here was taken out with a higher run here, then that would be a bearish breaker. Bearish breakers are much more stronger in terms of resistance than a mitigation block. A mitigation block can be traded through. So in terms of how I use mitigation blocks, I typically side with using them as targets more so than entry, because they can be traded through. Breakers are kind of like, they're pretty formidable in the path of price action. It doesn't mean that they can't go through them. It doesn't mean I've never had a losing trade using a breaker, because I have. But mitigation blocks are better used for targeting purposes. I was using this one here with the expectation that the NASDAQ could try to gravitate towards that. If it were to go any higher, this small little fair value gap there, and obviously the buy side above it. So knowing where the market's going to go to, that's a directional bias. Listen, at some point, folks, unless you trade options and you're delta neutral, you have to have a directional bias. There's no way around it. You have to. Otherwise, you're writing options. We don't need to predict the future price direction. Well, yes, you do. If you want to be profitable, or at least consistently profitable, like, you have to have an understanding of where the market can gravitate towards. If you don't have that skill set, you will not be consistently profitable, period. End of story. There's nothing else to discuss. I wanted to see us gravitate towards this mitigation block. It would be above the relative equal highs here that had already been cleared through here, and we consolidated. Markets don't top like that. Okay, and it was more likely that we're going to expand higher. It did. It reached into the mitigation block. It actually closed right on it. So that's rather decent, isn't it? So ahead of the week open, we were expecting price to go higher. And we have this candle right here. Now, on this candlestick chart here in the lower left-hand corner, this is a daily chart of the NASDAQ. So if we see this down close candle after, if you look at the weekly chart here, there's a small little fair value gap right in there. That's this one here on the daily. So the market traded higher there. And then we have this down close candle, which is right above and digging into this down close candle. This is an order block. It's bullish. This is a propulsion block. Propulsion blocks are order blocks by themselves, but the way you differentiate what they are and how they're used is this down close candle digs into a previous down close candle. So an order block that has another order block that digs into it. Propulsion blocks, you never want to see a closing price below mean threshold. Mean threshold on an order block is the 50% level. We wicked down through it, but then closed here. This one here, we wicked down through it and closed right here. We wicked down through it and closed up here. So yes, we had the movement through the mean threshold, but we didn't close below it. So that still keeps this down close candle valid as a propulsion block. Friday, Thursday, Wednesday, Tuesday, Monday's trading. All of this movement here was just returning back into this gap, this tail on this candlestick. We treat wicks and tails on candlesticks as gaps. Midpoint of that gap or tail on that candle is consequent encouragement. Extended out in time, you can see that's exactly where we were trading on Monday. It did not violate the rules that make a propulsion block invalid. Market closes here, and now we open the next day. We open, trade down, rally back up, and have an up close. So the next 2 days we had news. We had pretty good economic calendar events for the rest of the week, and it sent price parabolic above the relative equal highs. So the draw on liquidity is the weekly chart mitigation block. So this movement here, this was fully expected. We were expecting this bullishness in higher prices on NASDAQ. We were expecting it in ES as well, E-mini S&P. But we look for things to start or instigate a price rally higher or a price decline lower. And we frame it on the basis of where are we at right now versus where is it likely to go. So if we think that the price is going to gravitate up to this area here, if we start the week here, Monday, and then Tuesday, and Wednesday, and Thursday, and Friday, we expect each daily candle to gravitate towards that level. Even if you didn't pick that level, if you felt that this fair value gap was a reason to keep going higher, that's fine. There's nothing wrong with that. But this mitigation block is below that fair value gap. And if you were using the relative equal highs as a draw on liquidity, there's nothing wrong with that either. Remember, the only thing we're doing is primarily looking for the expansion either higher or lower on the weekly candlestick. That sets our bias for the week. So is it more likely to see where price was consolidating here? Is it more likely it's going to drop down after we've already went into this fair value gap here? We already did that. And then we consolidated here the previous week. And then we start a new week here, trade down a little bit, and then reject it, which is all that rejection is based on this consequent encroachment, this daily candle right there. That's where the low of the week was formed. So this is primed to just obviously expand higher, aggressively above these relative equal highs on the daily chart. So there's buy orders resting above that. Markets don't top like this, folks. They don't do it. And since the weekly and the daily chart are showing this pattern, it's more likely to go higher, especially since we were bearish on dollar. Not just bearish a little bit, but we were exceedingly bearish, expecting it to reach for a larger pool of sell-side liquidity. So if that is the case, that means it's definitely a risk-on scenario, meaning all assets have the likelihood to go higher. Euro, pound, gold, all other asset classes are free to move higher because it's risk-on. And we saw a huge risk-on event this past week where most asset classes went up while the dollar crashed. Over here on the hourly chart, I want you to notice this little shaded area here. That's the propulsion block. That's this whole range here, but visible on a hourly chart. So we have relative equal lows here. We drop down into it. We trade above this short-term high right there. That's all it needs to do. That's a shift in market structure. It doesn't need to close above it. It just now sets the thing in motion that we're going higher. Doesn't mean you can't have retracements, but look where it retraces. If you take this propulsion block right here and you divide it in half, that's mean threshold. That's what this drop was going to right there. It's going right there, and it's also cleaning up these smooth edges in the bodies. Wait a minute, that's not smooth edges, ICT. Look at this wick right here, or this tail, and look at this right here. Look at the bodies. The bodies tell you the story. That's the narrative. The wicks do all the damage. That's the stuff that everybody gets hurt by. You get stopped out, and you don't want to go back into the marketplace. That's their purpose. Reading price action with a time-based chart and focusing on the bodies of the candles. If you just saw these right here like this, and there was no wicks or tails on your candlesticks, if you took that completely off your chart, this would look like smooth edges. And that's all this was, trading down into mean threshold, which is the entire range from high to low. Split that in half. That's this level right here. That's occurring right in this level, digging into it after we had a shift in market structure. So what am I saying here? At this point, right there, that's slightly higher high than this one, because we've had sell side taken there. Now we have buy side. We're bullish. So we have now met the minimum criteria for high probability directional bias. So now we can absolutely predict higher prices. We can trust that higher prices are likely to go where? Up in here, this mitigation block. So if we're looking for a 15,693 level, and we're down here, and we drop down to mean threshold, at that point, does the market want to rally away from it? Sure looks like it does to me. Tries one more time, digs into it, but look where the bodies are showing. They're showing that it's respecting that propulsion block right there. We've already did the damage to going down into it, and here bodies are supporting the high end of the propulsion block, that shaded area. And then we want to see, does the market want to rally? And from here, as soon as we get these candlesticks showing this, and this candlestick closes, the next candle here, and it drops down and touches this, the high of this blue shaded area, which is this candle, that range on the daily chart. We're working with the hourly chart here now. I know that we're likely to go higher. Where? We have all this sell side imbalance, buy side inefficiency. So basically this candlestick's low. And then we have the buy side above this high here. There's buy stops resting above that. But this also is another pattern. It's a breaker. But if we're expecting price to go up to this blue line, and we're seeing evidence that all these things down here, stops have been taken, it's swept, we have all these bodies here, which is relative equal lows. Forget the wicks, go back into the bodies. They're telling you the narrative. That's the storyline. That means they're going to want to sweep through it. There you go. It's happening right there. So when this is a full bearish candle, I would be buying that. You probably wouldn't. But I'm leaning on this being a propulsion block. This is an order block that's already confirmed that it is. We broke through this candle's close right here, which is a rejection block. It's showing a willingness to want to go higher. I don't need this high to be taken out. It's went above this one here while I'm bullish. This down close candle is a propulsion block. So that range I'm shaded here, I'm putting that and transposing that onto an hourly chart. So I'm watching price action on an hourly basis, how it performs. See, when I have the high, the low, and the mean threshold price point of that candlestick right there on the daily chart. And I have on my notepad, daily propulsion block, high, mean threshold, low. So I'm watching price when it's meandering around in here. I'm watching time of day and how it responds at those specific levels. Because I'm predicting, I'm anticipating, I am not reacting to anything. The only time that I react is if I'm wrong and I see the evidence in price action that I'm offside or am likely to become offside. Then I'm going to react to that new information and say, okay, I got to bail on the trade. That's the only permission that you're ever going to get from me to react to price. Because everything else, we are absolutely predicting price. You are doing that. You're predicting the future. That's what this is. It's future. It's why they call it futures trading. It's in the name. And why are you arguing saying you're not trying to predict the price, or you shouldn't be trying to predict the price? You are. If you are bullish, that means you are predicting higher prices. If you're bearish, you're expecting and predicting lower prices. How are you reacting to anything? If you're reacting, it means you're chasing price. I'm not chasing price. I'm waiting for very specific things where price will walk into my crosshairs, and when it does, it's going down. I'm going to pull the trigger, and I'm getting my entry. I have 81 ways to get in there. Trust me, I'm getting in there. If trading was like a cat burglar, I'd be the best one at it because I can get in that bitch. So we have the mean threshold here, rallies back above, relative equal highs have been cleared here, and now the bodies are showing that there is an interest in seeing no further decline. Well, how do I know that? Because the bodies are not closing inside that blue shaded area. It's already done the work of doing what? Trading down into mean threshold. One more time, shifting higher. So market structure is now, again, one more time, bullish. So where's their inefficiency above this price point right here? When this candle closes, this one right here, when it closes, where is the draw on liquidity from that price point there? Well, you have this short-term high. Well, and versus that, I don't care. Because my focus is on, it's going to roll right back up this inefficiency, which is a SIBI, sell side imbalance, buy side inefficiency. It's a classification of a fair value gap. But then once it goes to this level here, it's not done in my opinion because my focus is up here. So I'm reading the tape. I'm watching how it delivers all through here. Once it gets to this price point here, I'm going to anticipate. I'm going to predict. This is where I would be in my live stream. This is where I would be in my recording of my execution. I'd be typing out big range candles incoming. When it gets right here, right to that price point low, right there, I would be typing out, we're going to anticipate, we're going to expect, we're predicting, we're not going to be surprised by large up close candles. Why? Because it's going to make a quick run for the liquidity resting above this high. That's what the algorithm does, folks. So we have an ICT bullish breaker here. These are the instances where you see classic support and resistance ideas come in. And this right here, this is one of those videos where someone's going to come back in the future and say, see, all ICT is doing, he's showing you classic support and resistance, and this is nothing new under the sun. No. No, trust me, we're going to go deeper. I want you to think about why this level would be sensitive anyway. I want you to think about how the market from this high traded down and then traded up and then through it. What does that make this range from this low to that high. Once we broke out above this high here, which is what we were anticipating, we're not breakout traders. We're not reacting to price. We want to see that. But what makes this a very specific range? This becomes a balanced price range. What makes it balanced? We had a high. We traded it down. So sell side delivery has been offered, not sell side liquidity. Sell side delivery is any price run from a high to a low. We have had sell side delivery from here and here, that range. Now, when we run right back over that entire range again, from that low up to that high, which is what we're doing here over time, as soon as we break through here, this high to that low is now a balanced price range. There is absolutely no reason to anticipate, expect, or want to see price come back down below that low. Why? Because the focus is up here, folks. We're expecting, we're predicting, we're anticipating the market to footprint its ass right on up to that level. We want to see that. We're expecting that. So where is the mile markers at going to be? Where's the rest stops along the way? Well, when the market runs above this area here, it's more likely to do what? Treat this level here as a breaker or a springboard to go higher. Why? Because this high has a lower low that's higher than this low over here. I'm not showing it to you because I want you to look at the commentary from yesterday. So the market comes back down. Does it wick through that high? Absolutely. And that's permissible. That means it's allowed. We expect that. We anticipate that. We're not reacting. We're not scared by it either. Look where the bodies close. Right here. And it opens right there. So there are wicks that are going down into this buy side imbalance, sell side efficiency, which is the BISI. It's a fair value gap. But what specifically stands out here? What is that? What's the segment between this high on that candlestick right there to this candlestick's high? What is this area? What is that? It's inefficient. But then when we see this candlestick here trade down into it, it erodes some of this inefficiency. So it starts from here to here. This area here is a breakaway gap. The reason why it becomes a breakaway gap and why we would never expect the depth of market, the DOM, even if there was bigger orders below the marketplace here, okay? If there was a stacking of orders below that were really large, okay, big interest to draw into that area down there, they're not going to go down there. Those things are not going to fill. What? Yeah, because it's going to go higher. Because this area is going to stay open. Why should it stay open? Because it's running out of this range right here. It's already done the work of digging into this daily propulsion block. So this is why you cannot look at one candlestick chart, one time frame, and follow the narrative. You can't be done, folks. Do we get that confirmation with the body staying at or above this high here? Yes. Does this stay open? It's not trading back down into it. You would never expect this if you're my student. You're never expecting this area to be printed into anymore. But I promise you, and I've seen it, traders are looking at those things and they're expecting it to go down because they think this is an inefficiency now because ICT's talked about it. No. So the market should be rallying higher. Where should it go? Well, where's the next draw on liquidity? Near term. Yes, this is it up here. But what above this high exists in terms of liquidity? Buy side. So the market right here has buy side. The market draws up into it. What happens before it gets to this run right here? Right here, this run right there. What happens? You see this wick right here? You see that wick? Half of that is what? Consequent encroachment. Interesting how it goes right down to it right there. Interesting how we have a gap right there with a wick. So if we have a gap like this with a wick, always trust and allow for it's likely to go into this consequent encroachment, not just fill in that gap right there. So it can trade down, even though it goes over top that gap, the candlestick's high right here. If it went through that live, I would not be unsettled by that. I would not be scared by that. I would look for this candlestick's wick right here. The midpoint, which is consequent encroachment, we treat that as a gap. The market goes right back to it there. Then what does it do? Right back up here. All right, so when the next candle opens up, I would be looking at that and saying, okay, now I want to see it start expanding towards this high here. and I want to see it aggressively run through it. I want to see speed. Well, we get it there. We come back down in. What is it doing? It's working inside this wick, which is what? A gap. We do gradients on wicks. 75% of the wick, 50% of the wick. We never want to see, in this case here, lower than 50% or consequent encroachment. So any respect of this wick should be limited to the high, 75% of the wick, and then consequent encroachment, which is half. So in my mind, when I'm watching price action over here, I don't want to see it go below half of that wick. Go over here, look what it's doing. It's going down, but it won't breach on a closing basis midpoint of that wick, which is consequent encroachment. That's tape reading. So the market does what? It rallies above this high here. What's above that high? Buy side, buy stops. Someone is chasing that lower when it's green. This is an hourly chart. So inside that weakness in that hourly candlestick, someone's going short. Where they're going to place a stop? Right above that high. So the market does what? It gravitates up to it here, and we drop down, respecting consequent encroachment there, and we rally. What do we do now? We start expanding aggressively towards that weekly mitigation block, this level right here. And we trade up into that level there, and then we consolidate. Markets do not top like this. Once we trade through it here, right there, what does this area or fractal and price action become? The same thing I told you this becomes, a balanced price range. From this candlestick's high here, up to this high, then back down. Once we clear this high here, this whole shaded area becomes a balanced price range. I am not concerned about price wanting to, at any time up here, going back down inside this range. So for stop loss management, your stop loss can be anywhere in this range and feel pretty confident that it's not going to get there. So how would I do it and sleep good at night? 75% of that range, if my stop is below that, I'm comfortable with that. Some of you get crazy about how I'm using my stops. Sometimes they get really close to what you might be scared to do at the time. When you're watching my executions and you're seeing it, you're thinking, man, this is crazy. I wouldn't feel comfortable, because you just don't know. I'm teaching you right now. These are long videos. These are very dense, very demanding of your attention to learn. And that's expected. I didn't tell you it's going to be easy and watch a video and you know how to do it. I warned you ahead of time. It's going to take a lot of work, but it's something that it's worth doing, because once you have this skill set, nobody can take it from you. They can make jokes about all they want, but they're never going to be able to do what you can do once you master this. Look at all the things here on this 5-minute chart. Do you see anything that stands out? But I want you to see, and compare and contrast, the price action on the 5-minute. We're going to drop down to a 4, 3, 2, and 1. But we're going to focus on this little area. Why am I focusing on this area here that's shaded in? From this high down to that low, and then how we start to deliver going back up. Because the trust is that there's no necessity to go back down into this area, which is a breakaway gap. Because this line here is your bullish breaker. Everything is indicating that order flow is supporting that idea. The time-based chart will tell you everything you need. I'm not bringing everything into this fractal here. Only things that stand out in this fractal. I can only deal with whatever PD arrays exist in this shaded area. So watch this shaded area. This is the 5-minute chart. Now we're going to transition into a 4-minute. Okay. Notice any changes in here. This is the part of the video you're going to want to go back and study independently, or look at it from your own chart. Now we'll look at the 3-minute chart. Okay. Notice all this here. What is price doing? I don't need a depth of market to show you what I'm about to show you. 2-minute chart, same range, but it looks different, doesn't it? And finally down to the 1-minute chart. Now, this green line here, again, is the hourly bullish breaker, that high. We dig into it here 1, 2, 3 times, and then we have a swing high broken to the upside. The last down close candle prior to that shift in market structure, that down close candle is a bullish order block. That opening price is a change in the state of delivery. Now, huge leap forward for people that want to learn order blocks. Okay. For the record, order blocks have 0. Notice I'm not talking about depth of market here. Notice I'm not even pointing at a ladder. I'm not talking about footprint. I didn't even talk about volume. I don't care how many orders were purchased or sold short. in this candle. It's irrelevant. That has nothing to do with my order block. This candle right here, the open of that candle, the change in the state of delivery is when that candlestick's opening price is crossed right there for the first time. When that happens, then and only then, never before, never another time in the future, that validates this down close candle as a bullish order block. Now, why? What makes that an order block? The fact that we have this bullish hourly breaker, the fact that we traded down into it, and then we see a shift in market structure. Then we go back to the down close candle, the last one, prior to a run higher that has a shift in market structure. There. This is not an FU candle. This is not an engulfing candle. I don't care if this candle started here. It opened here and went down. Or if it opened here and went down, I would draw it right on the opening price. It has nothing to do with engulfing. It has nothing to do with anything else except for what I'm teaching you right here. End of story. That's just the facts. This becomes a bullish order block as soon as that candle crosses it. What? The opening price. That's the change in the state of delivery. As soon as that occurs, this low should not be violated. So you can now start looking for bullish PD arrays that are in discount. Well, everything's in a discount now because we're so far down. But we have a down close candle right here. So we can use that opening price, extend it forward. Anything in there, buying this, anywhere in this area here, buying that, you can buy that with a stop loss right below there. Oh, that's a little bit too wide for me. Then don't take the trade. Wait for another run higher and wait for an inefficiency. Wait for a fair value gap. Wait for a breaker. Wait for a institutional order flow entry drill. Wait for whatever your model is suggesting that you should use. But look closer. We are now looking at that price range from this high up here all the way down to that low. We trust that that low will not be violated. Why? Because this candlestick was crossed right there. Now what happens? Let's play devil's advocate. What happens if it breaks that low? Okay, then you have to continuously study price action and wait for that same instances where we see a shift in market structure to the upside. In the last down close candle, we'll mark the opening price, and if there's a candle that goes above it, that validates the down close candle as a bullish order block. We have the ranges here. 75% of the range is a gradient, 50%, and then 25%. So I want you to notice how as price works very close to 25% of that range, again, the range is the high to that low, we are trusting that it wants to go higher now because we have a change in the state of delivery. When that candle starts moving above that opening price, now we have it. It's in place. We have a shift in market structure. All lights are green for going higher. How do we use this information? Look at price. Order flow. What kind of order flow? Institutional order flow. Easiest, right to the chase, no bones about it. Easiest thing is if we're bullish, we want to see down close candles support price. If we see a short-term low taken out, we expect to see that as a stop run, and then price should revert right back into going higher right away. And everything I just said, reverse it for when the markets are bearish. It's that simple, folks. Watch. We have a down close candle here. Draw it out in time. Does price support at that level? Yes. 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 Does it start moving higher? Yes. Does it take out short-term highs? Yes. Yes. Down close candle. Is price supporting it as a bullish order block? Yes. It's not going below it. Does price go higher and take out high? Yes, it does. We have a down close candle. Does price go down into it and reject that area and leave it and break a high? Down close candles here. Why am I picking this one? Because it's above this high here and this high here. So does it support price? Look at it. What happens when it hits it? It starts going higher. Does it take out a short-term high? Yes, it does. So is order flow bullish or bearish? It's bullish. What is it reaching for? A premium. Relative to what? The range, which is this high, to that low. That is determined by this level here, which is equilibrium. At that level or below it is what? Discount. At that level or above is what? premium. So when we get above this 50% level, it's far less probability, more risk if we start taking order blocks and buying them above this level, because we're in the premium range of this high to low. Doesn't mean it can't keep rallying. It just means that we have to do all of our buying below equilibrium or less while we're in a discount. That's the framework for high probability. Short-term lows being taken out, we expect that to be rejected and start seeing price go higher. We start to see it run higher here. Does it find support on this down close candle here? Yes. Sends it higher. Does it take out a short-term high? Yes and yes. We have a down close candle here, right around equilibrium. No return back to it here. That's fine because we're in an area where it's a short-term premium. Down close candle here. Look at the body supporting that idea, and then rallies higher. Highs are taken out. Down close candle, does it support it as bullish? Yes. Higher. So when I'm watching price and I'm on side and I'm expecting prices to go higher, I'm looking at every down close candle as a means or mechanism to support price. Or any swing low is a potential stop run. So I'm not in a hurry if I'm long to ram my stop loss between some random swing low, because that's exactly what the algorithm is going to do. It's going to sweep below them like it does here, like it does here, and like it does here. And then once it does that, around equilibrium, then it's going to go into another price leg higher. And then we enter a consolidation. What's below here? Sell stops. Now we can go higher. Notice also that we have all of these fair value gaps right here and all this in here. When we have a change in the state of delivery and we enter a buy program, which is where we are from this point on there. Well, what's going on here, Michael? It's just retracing. That's all it's doing. It's allowing for a deeper discount with that low staying intact. When this high is taken out here, notice that we have another return back into this order block. When we have this retracing back in the order block here, that's when we start seeing the more pronounced run higher. But look what's occurring here. All of this imbalance here, what is it lacking? Buy-side delivery, not liquidity, buy-side deliveries when there is a run higher in price. Look what it's doing. It runs higher. Look at the bodies respecting what? The inefficiency's high right there. This SIBI, that candle's low. What is it respecting? This candle's low here. And then what is it dropping down into? Consequent encroachment, midpoint of this candle's low and this candle's high. There, rallies. Where's it rally to? The fair value gap right here. So how do we use this information? They're inversion fair value gaps. These are like a mountain climber. Well, we're in a bullish market now. We're in a buy program. We're climbing a mountain. What's the mountain? This is the mountainside here. And this is the most sheer drop off. So this is the smoothest part in that drop off. So we have to use these areas to find what? Footing. There's little pockets. We have to wait for them to form. That means consequent encroachment, short-term low, trades below. What's it going to do? Trade back into this order block and take out that short-term low for sell stops. I'm not freaking out when I see that. I want to see it react at that order block, and then also that it's taken out liquidity, and there's also a volume imbalance right there. That's tape reading. So fair value gaps like this, if we're bearish, we expect it to go up there and sell off. But when there's a change in the state of delivery, we expect the market to go up. So all these down movements here, it's lacking what? Buy side delivery. So it's going to want to gravitate up into them. If it ever retraces into them, once it closes them in, we treat them as what? Inversion fair value gaps. So we see this consequent encroachment, which is midpoint of the shaded area, midpoint between this low and this high. Here, we rally up to what? This gap. We're treating it as an inversion fair value gap. Does that mean it's going to trade right here and go higher right from there? No, we have to wait and watch. What is this here? This is a buy side imbalance, sell side inefficiency. What is this right here? It's a swing low. We've had a nice move outside of the range of these relative equal highs, and we're into two inefficiencies. This one and this one. And now we have a short-term low. It's probable, not guaranteed, it's probable that it's going to run for short-term sell side liquidity. Stop hunt. That's what we're getting from here. It drops down. takes out that liquidity, also respecting consequent encroachment of this fair value gap. Then rallies. It rallies to this high and through this inversion fair value gap, comes back down, support, rallies back up. What is it creating? What's it creating here? Short-term low. So what's going to be trailed up right behind that? Sell side. Where are we at in the range from high to low? Here's equilibrium. We're right there at equilibrium. When this occurs, equilibrium is where you're going to anticipate, you're going to predict, you're going to expect a stop hunt. That's what the algorithm will do. And that's what you're seeing here. A run on stops. This one is 2 times. But returning back into what? This fair value gap, which is an inversion fair value gap. You would take this, extend it over. What is it respecting? This order block still, that's a reclaimed order block, but it's also in concert with this candlestick's low. It's respecting that old gap. So that makes this an entry off of what? This inversion fair value gap right here. The market finds support here, rallies. Takes out the high, and trades up into what? The next gap over here, which will be treated as what? An inversion fair value gap. So I'm looking at like a mountain climber here. I'm looking at all the potential finger holes where I can grab a hold to pull myself up higher. That's what price is doing. That's all price is doing, folks. When we drop down, we're taking out sell side here. And we're doing what? We're rallying off of the low of this fair value gap. So this candlestick's high. That's what we're respecting over there. Look at the bodies. It's telling you the story. It's supporting the idea that that is still the underlying narrative. Stops have been taken. Control mechanisms are in place. The algorithm is absolutely respecting that old fair value gap right here that we are cutting through candles because that's where the narrative is derived from. Inversion fair value gap for the win. Rallies. Order block. Touch it. Does it rally higher? Yes. Does it take out a high? Yep. Do you see what tape reading is now? Do you understand how we're working with time frames and we drop down to the lower time frames and we do not need any gimmicks to see what price should do? It's liquidity and inefficiency. It's discount and premium. Time of day. All these things come together to make a beautiful tapestry, and you're never surprised. Once you understand all this stuff, you're not surprised. You want to see these things form, and you're waiting for them to form. I promise you, all the things I'm teaching you, they keep repeating. But you want something that's easy. Go out there and 1, 2, 3, get me in, get me out, never have a losing trade. And I'm sorry, but there's no way to do that. Back on the 15-minute time frame. So what happens once we clear this balanced price range here? Remember, we hit the bullish breaker line here. We had all these inefficiencies in here. What happens when we get above it? What can we do now? Well, we have a target up here. That's a draw on liquidity. And then we have now this old market structure high. So now we can take that range and draw a fib from that high up to this target. Now we have gradients. So now we're grading a future price swing that has not happened yet. As soon as this candlestick right here closes, now we run from high to target and we run gradients. And now watch what happens. Around the 20, I have it backwards here. 75% or the lower 25% of the range between the draw on liquidity and the high that was broken. We don't think that the market's going to go down here. Why? Because this is a balanced price range. So we anticipate every instrument out there, every little gimmick, every little toy is going to say, oh, look, orders are getting eaten above market price. The footprint's showing that, look, it's bullish, just absolutely bullish. Of course it is. It's going higher. So we have relative equal lows, and they sweep that. Where does that occur? In the lower quadrant of the range from this high up to that draw on liquidity, which is the weekly mitigation block. That's what this level is up here. Then we have consolidation. Where does consolidation form, ICT? Oh, well, I said it in the core content lessons back in 2016, and I taught it to everybody that was my private one-on-one student back in 1996 at equilibrium, 50% level right here. That's where consolidation is forming. And then what happens? A stop hunt. Lower time frames, look in there, you'll see it. Rallies up. Another time here. And what happens here at the upper quadrant? From the draw on liquidity to this high, we're anticipating new price points that surge higher. That's what I'm showing you here. We rally up, then we take out the liquidity above that weekly mitigation block. Then we do what? We find some support at it. And then we consolidate going into Friday, New York session. That's where we're at now. This is a 15-minute time frame on Friday, and we're consolidating. Markets do not top like this, folks, especially ahead of news drivers. So a market report, we're expecting prices to go higher. We've consolidated. We're part of a bullish run, and we're expecting capitulation to come in. And that's what we're seeing here. The market rallies aggressively. What are we seeing here? See this gap right there? Extend that through. That's what you're seeing. That's an inversion fair value gap. Explosive run to the upside. Retracement. Failed to run higher. Back down into the sell side here for a TGIF trade. Let's take a closer look. 5-minute chart on the NASDAQ. Here's that price run here. Then we have this buy side imbalance, sell side inefficiency. We'll get to that in a moment. And then we run up. We have a blow off move, and then we break down. Where's the fair value gap in here? There isn't one in here. Not on this side of the curve. The curve is here and then down. So you have to use the imbalance on the left side. That's going to be an inversion fair value gap. Extend that through all the price action. That's what you're seeing here. And then you have a small little fair value gap there that I didn't want to draw any annotations on because we have the inversion fair value gap. I can point it out like I'm doing here. Trades up into it here. And we break. This area here is a breakaway gap. We want to see it stay open. So why should it become a breakaway gap? Because we have had a shift in market structure there. We have a buy side imbalance, sell side inefficiency. Relative equal lows, blow off move after the market has been going straight up all week as we were expecting it to. And then we have the inversion fair value gap. Is it respecting that? Yep. And then we break below the short-term low here, below this short-term low here. And where's liquidity at? Below here, sell side. But then we have this buy side imbalance, sell side inefficiency. So any rally from this candlestick open up into above this high, we want to see it stay open. What happens if it closes in? It's okay. I would still want to take a short up there if I was watching live. And the market breaks down. Doesn't get below the what? The bodies. So we still have this wick to contend with. So we retrace higher. Up close candles consecutively. That's a bearish order block. Breaks down through it. Extend the opening price over there. That's a change in state of delivery. Returns back into it here. And all of this consolidation is time distortion. It's not time for the market to do anything. It's not going to do it. It's already ran the low here, which is the lunch macro for New York. It's already did that. But we're not done. We have TGIF. It's Friday. So thank God it's Friday. It's likely to do what? 20 to 30% of the weekly range in terms of a retracement from the high of the week. Where's the high of the week? Over here. When can we trust that's the high of the week? When we see this element here, and then we start seeing everything start breaking down. This high is intact. But what happens if it runs up and goes higher? Then you're wrong. How's that for logic? You're going to get it wrong sometimes. But you have to have rules and things to work with to grow in your understanding as a trader, and this is what I'm sharing with you. What time does time distortion stop? What did I teach you? Post New York lunch, we start seeing 2 o'clock to 4 o'clock. That's your PM session time. Then all of a sudden, what happens? The market delivers a run through low, lower low, fair value gap. Trades up into it. Consequent encroachment of the low on this wick. Boom. Sells off, hits the sell side liquidity, and trades to the 20% level of the weekly candlestick. So from the high to the low, measure that, and it retraces 20% of the weekly range in here. All right, and here's a 1-minute chart of that time of day. Here's the PM session. And I want you to see that inefficiency, that buy side imbalance, sell side inefficiency. Let me take you back up so that way you know where I'm pointing your attention to. This range right here, okay, we're looking at a 5-minute chart. We're going to drop down into a 1-minute chart and look at price action from here to here. Okay, that's what we're watching. But in this shaded area right here, I'm going to put the gradients in, 25, 50, and 75. We're going to look at this return back into that shaded area here. Okay, so here's the lower quadrant, or 25% of the range that's shaded here. So here's the high, 75% of that range 50% of that range, 25% of that range, and the low of it. So the market trades up into that. And we'll come back to that in a second. But let's go back up into here and look at some of the details. Right away, this should jump off at you. That's a breakaway gap. Why? Why should that be a breakaway gap? Because we are under time distortion. That means all of this back and forth price action is just marking time. That's the benefit of knowing how to use a time-based chart. I'm not getting fooled by candlesticks. I'm waiting for time. When does it start? Right there. 2 o'clock in the afternoon, New York local time. Because the market is driven by an algorithm. There's a time for everything. A beginning and an end. A pause, a consolidation, and distortion where everything you try to do will chop you up. So you wait. Wait for what? 2 o'clock. And then wait for displacement. What does that look like? Right here. Takes out that short-term low. Boom. But now we have what? We're late in the day. This shaded area here is the buy side and balance, sell side efficiency. We have moved away from the high, and we moved aggressively away from the 75%, upper 75% range of this shaded area. So I don't want to see this area come back into. I don't want to see it come back up and trade into that. But if it does, I would treat it as an institutional order flow entry drill. In other words, a partial entry and then sell off. Either way, it makes it a breakaway gap. So we don't want to see it trade back up above 50% or consequent encroachment of this shaded area here. And now we enter into another time of day. The 250 to 310 macro. My algorithm starts at 250 to 310 and will start spooling price running for the liquidity that has not been purged yet. What is that liquidity? The liquidity below the lows. The 7 a.m. New York session time, the 8:30 lows, the 9:30 to 11 lows, all of that is the draw on liquidity. And or, in this case, 20% of the weekly range. That would be anywhere in this area here. But we start to see this energetic price run, aggressive dropping lower. That's algorithmic. This right here, just like I talked about earlier, when we ran up, you can use the fair value gap on the left side of the curve. And we're seeing that happen right there. If it would have been opening here, traded up right there, if I was wanting to trade short and I hadn't already been short, that would be an area where I would go short right there too. Then it breaks. This is a measuring gap. We don't want to see that filled in, just like we don't want to see that. What makes this a measuring gap? Well, between this high down to this low, we're expecting that run. And about halfway, we're expecting a gap to form. When it does, and it moves away from it, we are not expecting it to come back into that. That's a measuring gap. You have to know where the market's likely to draw to. If you don't have that skill set, you will not be consistent in your ability to define or classify a measuring gap. Breakaway gaps are just gaps when you want to see an energetic price run away from an area you anticipated prior to it running away. So you're expecting it to move lower? Great. When it finally does and it creates a gap like this, your first thought should be, okay, the first fair value gap after it starts to run, that should be a breakaway gap. We want to see that, especially if we've been in consolidation or experiencing time distortion. Time distortion is simply a matter of time between segments of time of the day where markets will start spooling. That's it. All right, folks. So I covered a lot of stuff here, and I will admit rather openly that this is not one of those easy go out there and I can do what ICT just taught me. Okay, but I'm showing you many things here. I'm showing you a amplified version of what we do by reading the tape. I've rung in macros. I've rung in time of day. I've rung in how we use breakaway gaps and measuring gaps and how we anticipate price action. And we don't look for ladders, depths of market, footprint, or any of those things because we're anticipating price performing a specific function. We understand order flow. What kind of order flow? Institutional order flow. Institutional order flow is going to be based on the things I'm showing you here. Price is the thing. That's the context. That's the prize that we seek. The better understanding of that. You can take the open, high, low, and close of every interval and beat it up, torture it with number crunching, and have it come out with all kinds of supposed insights, some kind of mathematically derived indicator. Or you can take the past and say, okay, this is how many contracts were bought or sold at this price, and therefore I believe this or that. Or you can look at a range above the marketplace price or below the marketplace price and determine, and there's a larger range of or number of orders above the marketplace than that of below it. And you might think that is indicative of wanting to go higher. Not always. Think about it. What happens if you're in these types of situations here, where you're right before the market is going to start going lower, but your depth of market, your ladder, suggests that there's a lot of orders just above the market price? You might be convinced by looking at just that tool, thinking that, okay, it should start going higher and eat into that number. No, that might be just a large pool of smart money's stop loss that isn't going to be tripped, that isn't going to be eroded or eaten into. And then you watch price run away and you're thinking to yourself, wow, look at that rip. Wow, look at that. Where'd that come from? What just happened? Somebody must be talking. All these things, folks, all these things come out of the mouths of people that just don't know how to do this yet. And I want them to learn. That's all. I want them to learn just like you. I want them to understand how they can capture these types of price runs and not hurt themselves in the process.